Awesome. So thank you everyone for joining us for our cash flow management webinar. My name is Tommy. I'm from the Small Business Development Center at Chinese Mutual Aid Association. Before we get into the presentation, just wanted to give you a quick little background on who we are at our center. If you're not familiar with us, we're located in Uptown Chicago and provide, as you can see, a wide range of no-cost business advising to small business owners all across the state. So I'll be putting links in the chat if you're interested in some follow-up, if you're interested in working with one of our business advisors on really any topic you need or you see here, we would be happy to do so. We've been lucky enough to be joined by Eduardo Aguilar. I'm sorry if I mispronounced that, but he is from Old National Bank, and we'll be covering some important cash flow management tips and other sort of financial literacy points that are going to really help your business. So just one more quick slide here, some registration info. Like I said, I'll be putting all the links in the chat. I also just wanted to make note, I have sent everybody who's registered an email, and you'll find a participant's guide in there, which I would recommend to pull up and sort of have that open while the presentation's going on, just to be able to follow along. So without further ado, here is him to tell you more about cash flows.
Thank you, Tommy. So again, my name is Eduardo Aguilar. I'm a small business development officer with Old National Bank, formerly First Midwest Bank. So what we're going to be going over today is we're going to be looking at financial education curriculum established by the SBA, which is a Small Business Administration. Specifically, we're going to be looking at managing cash flow. So what I'm going to do at this time right now is I'm going to share my screen. So just one second. Okay, and at any time, if anyone has any questions, please feel free to use the chat function within the Zoom presentation, and we will try to answer your questions as soon as possible. So here we go, and I'm just going to turn off my camera. Okay, so here we go. So welcome to Managing Cash Flow. Taking this class is an important step to building a better financial future for you and your family. As a small business owner, it's important for you to know how much cash is moving in and out of your business. You need to think ahead in order to meet your financial obligations and run a profitable business on a long-term basis. This class is going to introduce you to some of the basic cash flow concepts that can help get you started. Now, within your participant guide, there is a pre-test, so we're not necessarily going to take the time right now for you to go ahead and take the pre-test, but there are some questions there that you can kind of look over while we're doing the presentation to see, exactly what your knowledge and skill set is when it comes to understanding or managing your cash flow. Okay. Okay. Okay, our agenda for today, as you can see, it's we will discuss concepts. There's the self-assessments, there's going to be some interactive activities, and then we're going to respond to your question. Please help us stay on schedule. We do not include a formal break, but if you need one to visit the restroom, please feel free to do so. Okay. What we're going to be looking at is we're not going to do formal introductions for the sake of time as far as other participants. What we are going to be looking at today is we're going to be looking at a case study. It's going to be Bob and the Wired Cup is our case study. It's our example. We're going to be looking at the balance sheet, 3 views of cash flow, and specifically as our case study, what can Bob do? And then we're going to have a summary of what we've reviewed. So, okay, learning objectives. So what we're going to be looking at is we're going to be looking at cash flow management of a startup business. We're going to be assessing cash flow cycles and make some cash flow projections. And we're also going to be describing how cash flow statements can help assess and improve financial health of startup businesses. Additional learning objectives is we're going to identify ways to manage cash flow in terms of managing costs and potential income. We're going to identify ways to seek out expert technical assistance to improve cash flow and management. So we're going to get started. So what we're going to do is we're going to introduce Bob and the Wired Cup. This is just a sample small business. So we're going to use this realistic example to review a new business owner's cash flow management decisions. As we review Bob's cash flow issues, you may find that these concepts relate to your own cash flow questions. Okay, so we're going to be introducing Bob and the Wired Cup. Okay, so this is the scenario. Bob recently opened a new bakery cafe, the Wired Cup. The cafe has a great location in a small college town. To get started, Bob invested $30,000 of his own money and received a $20,000 loan from a commercial bank. He spent $45,000 on startup costs, leaving $5,000 to run the business. So the Wired Cup is already popular with students, university staff, and neighbors. Everyone loves the coffee and baked goods. A college dean has started to order croissants for the faculty dining hall. Bob is building a great business. However, Bob has some concerns. He has not yet paid himself, and he wonders if he can. The $5,000 is almost gone. Given that his key customers are students, he assumes that many will go home over the holiday during break and summer. Questions Bob is asking is, how will he pay the bills with fewer customers? Will he have enough money to ramp up again in September? Should he buy in bulk to reduce his costs? Will suppliers allow Bob to buy on credit, or does he still have to pay cash? The good news is that Bob is thinking ahead. He has time to find solutions, and as we review the Wired Cup's cash flow issues, you will be able to apply these concepts to your own business. So there we go. Before we go on, let's learn about Bob's cash flow experiences. It'll be helpful to learn your background and experience so far with cash flow and management. So I'm not sure exactly here, maybe we can get in the chat as far as what would you consider yourself, if you could just put in the chat, beginner, intermediate, knowing some information about cash flow, or an expert, really, you're really well versed in cash flow continuum, and you have a business that's been around for a while. So, maybe some of you, if you don't mind, just putting in the chat, I'd like to get an understanding of, what level you're at when it comes to cash flow and analyzing cash flow for your business. So. Okay. Okay, so we're getting some responses, so that's good. So chat should be, I'm seeing some responses that some people may not be able to chat, but I am seeing some responses, so it should be enabled. I do see that, we have a good mix of beginners and intermediate. Not sure there, Tommy, there's a couple that say that it's disabled. So I'm not sure if you might be able to help them with that.
Yeah, thanks for pointing that out, everyone. I will look into the back end settings here and try to get that up and running for you. Looks like the Q&A chat is working. So if you're able to use that, I'm going to try to get the chat
Got it.
working out.
Okay. Yeah, I'm starting to see more responses now. So, okay, so it's a good mix between beginner and intermediate and, okay. Okay, looks good. So we're going to go ahead, we're going to continue. Okay. Okay, so if you have the participants guide, if you wouldn't mind turning to page 5, and that's the Wired Cup's opening balance sheet. Now you can see it up here on the screen. It might be a little bit small, but that's fine. The participation guide has it. So, okay. So this is a pretty basic standard balance sheet. I can tell you that as a small business lender, this is something that's very important when we review. It's kind of a snapshot of what's going on with the particular business. Many times when we're taking a loan application, we'll ask for the annual financials, the tax returns, but we'll also ask for either, an opening balance sheet or a year-to-date balance sheet to just give us again, what I mentioned, a snapshot of assets, liabilities, and just basically what's going on with the current client. So the categories here that you see within the opening balance sheet are pretty standard. You'll have your assets, your liabilities, your equity, and it's pretty common. So, okay. This balance sheet lists pre-opening expenses as current assets. In this example, the pre-opening expenses listed were expensed or realized before the end of the year. So entrepreneurs should always keep track of pre-opening expenses, as many may not be considered by financial institutions or investors as a business asset or owner's investment equity. This opening balance sheet tells a story: how much money Bob had to start his business, how he financed it, what he did with the money, and how much was left over to run the business. The balance sheet tells us that Bob invested, I'm sorry, just one second, go back. The balance sheet tells us that Bob invested $30,000 of his own money or owner's equity, and he borrowed $20,000. The $20,000 is a loan that was done over 5 years with a 14.5% interest rate. In year 1, Bob will pay back $3,371 of principal and will pay the remaining balance of $16,629 in year 2 through 5. If you don't have the necessary capital to start your business, you have 2 options to get the capital that you need. There's equity, which most of the time comes from friends, family, or business partners that invest in your business. They provide you with cash. They give you equity or a piece of the business. Debt. Many people finance their business. You borrow the money from family, friends, or lending institutions such as bank. You don't give up equity or ownership, but you do have to pay back the loan. You will pay back both principal and interest. There are many types of lending and borrowing options. Just a few notes about debt. It takes some effort to obtain a small business loan. As part of the process, you will need to provide a business plan. Within the SBA curriculum, Money Smart for Small Business modules, we have a actual module that says planning for a healthy business. It provides a lot of information about various ways to plan for a successful business. It actually will help you with your business plan. Knowing your credit score, the higher your credit score and the lower the risk for creditors, something really important. And we also have modules on just understanding credit reporting and understanding your credit. So, if you are interested in, if you know your credit score, but you've never had the opportunity to actually drill down and look at your credit report and find out what, each line item means, or, how your credit is being reported, credit reporting classes are definitely something that I would recommend, and we will look to schedule those in the future, but we can go over a credit report so that you can understand exactly what's on a credit report. So banks have different criteria for lending. I would recommend talking to your local banker before you need a loan. The stronger your relationship is with a bank, the more supportive they may be to help you secure a loan and to let you know if you meet the lending criteria. We have a Money Smart module also called Banking Services that can help. Be prepared to personally sign for loans. Many banks require a personal guarantee. And also be prepared to pledge collateral. So there are several different types of loans and programs out there. Many times they'll look to see what collateral is available. There are loans out there for small businesses that do not require collateral. And that's something that we can definitely talk about, because that's very important. We have a lot of startup businesses that won't necessarily have collateral, and there are a lot of programs out there, and we can definitely get you some of those resources for some of those programs. So one last note is make sure you manage your credit cards. Many times, a lot of startup businesses will access credit cards for their startup capital. That's one of the ways to actually be able to finance startup businesses, but we just be very careful. Most of the times that there are high fees and interest rates, and business credit cards may be one of the most expensive ways of financing your business. So, okay, let's go back to the balance sheet. In total, Bob has $50,000 to spend to open the wired cup. He spent $45,000 on equipment, material, and other assets as indicated on the balance sheet. You can see there that you can see $29,500 was for fixed assets. You have $15,500 for current assets for a total of $45,000. He reflects $5,000 in cash remaining to run his business. So then you're looking at 50,000 minus 45,000 equals the 5,000 that he has. If I was Bob's lender, potential business partner or vendor, I would look at his opening balance sheet and ask the following questions. Has he invested enough of his own money in this venture? Did he finance the business wisely? For instance, does he carry too much debt? The terms and times requirements for the loan repayment can make a huge impact on his cash flow. Did he wisely spend the $50,000? You can take a look here and you can see that is there enough available cash left over to run the business? Is $5,000 enough to carry him through a 6-month period? We don't necessarily have the time to discuss these specific questions in details, but I'm just explaining that in an opening balance sheet, it tells you the story that can right away lead to constructive dialogues with the borrowers. So, right away, when you look at this balance sheet, you look at, you can see such expenses that stand out like legal fees. Many times there's good conversations that could be had by legal fees. Sometimes the legal fees are just startup fees. There may be a recommendation by a banker or another friend as far as like, the legal fees seem a bit high. Do you know that, maybe I can help reduce some of the legal fees? You can also look at, you see the specific payroll taxes. So you look at some of the pre-opening expense items that are involved in this balance sheet. So, okay. Let's look at the 3 views of cash flow. Okay, I'm sorry, just one second. There's a ambulance driving by. So, okay, the 3 views of cash flow: a cash conversion cycle, a cash flow diagram, and then the wires cups cash flow statement. Combined together, these 3 views provide a comprehensive overview of a cash flow system. The cash conversion cycle. A cash conversion cycle consists of 3 components. We're going to look at, there's a business pays for raw materials, number 1. Number 2, you have the business makes a product or service using those materials. And number 3, you're looking at the business sells the product or the services. The trick is to know how long it'll take to complete the cycle. The rate of conversion impacts cash flow. If you have a short cycle, Your sell inventory or turn it back to cash quickly, which puts money back into the cash flow system. If you have a long cash conversion cycle, you'll not be able to use that money while inventory is sitting on your shelf. So there's a lot going on here in this cash flow diagram, but I think it's a pretty good diagram that kind of lets you know how everything is tied together. So another way to describe the cash flow is with this diagram. This diagram is on page 7 of your participants guide. We will review this diagram to get a big picture of cash flow and how all the elements, the pipes and the valves work together. Okay, this cash flow diagram. This diagram is a representation of how cash flows in and out of the system. It depicts many decision points or valves you control. When you start a business, money flows into the business via debt or equity. In the case of the wired cup, Bob had $30,000 of his own money invested in the business. The equity bucket in this diagram, in addition, Bob borrowed $20,000, the debt bucket. The combined $50,000 is the available cash working capital. The valves in this cash flow diagram represent decision points. Your decisions impact cash flow and increase or decrease your probability of success. Some valves are open all the time, such as sales tax and debt. You have to pay for them. They are consistent drain on your cash, which is why they are at the bottom. Some valves are partially open, like the sales, general, and administrative valves. What you spend is up to you. As you spend available cash, the balance in the center of the tank drops. Let's look at the inventory. Inventory, it says you spend money on raw materials, labor, and other direct costs to produce a product to sell. Assuming you're producing a product, the same principles apply for services as well. If you spend a lot on inventory, you tie up a lot of your money until you sell the inventory and turn it into cash. Fixed assets. Fixed assets are usually expensive buildings, upgrades to spaces, vehicles, equipment, computer technology. If you purchase an expensive fixed asset, it's going to tie up your cash. A better option may be to lease that in order to keep your cash flowing. So let's look at profit generators. So the sales pump. In the top left corner, we have a sales pump. Keep this primed to pump sales back into the system. Accounts receivable. So accounts receivable is really important. There are many banks that can do lines of credit or lending based off your accounts receivables or AR. You may make a sale, but not receive cash until you collect it. Ultimately, you want to convert the AR or accounts receivable into cash. So it flows into the center of the tank and becomes available. Some accounts receivables will not be paid. This is called bad debt. Usually after 90 days, an account receivable will not be paid. Now that varies depending on whether or not, you may have some government contracts or may work with some municipalities that are always constantly late and may pay over 90 days. But I can tell you in general, banks will look at accounts receivable up to 90 days. Many times they believe that, after 90 days, if you've not collected on the funds, that they will turn into bad debt or, may not be fully paid. But again, this can be mitigated on whether or not it's, maybe a government contract or, a contract that just naturally will pay past 90 days because of the way you have it set up. So when you extend credit and create an accounts receivable, you need to follow up to make sure that you receive that payment. I can tell you that at the bank that I work for, the way that we will look at establishing a line of credit is we will grab the total amount of your 90-day account receivable. So what we do is we add up all the money that's owed to you or money that you have invoiced out, and it's due to you within 90 days. And what we do is we grab that total and we'll multiply it by 80% to establish a maximum line amount. Now, we're also going to be looking at your gross sales, but many times the account receivables is what we're going to be looking at to establish a line of credit. So, there's many businesses out there that are seasonable, that are, basically have different high points in their accounts receivable depending on the season. So we always recommend that when you're establishing your initial line of credit, let's look at a snapshot in time when your accounts receivable is at its highest, because that's what we're going to be establishing the line of credit using the total amount during that period. So let's look at accounts payable. The accounts payable is in the center tank. Accounts payable are represented by bricks. This is money owed to vendors and suppliers who extend credit to you. For example, you receive a product or a service, but you have not yet paid for it. You still have use of that money. The bricks elevate the water. Instead of having to pay for the product or the service, you can use that money for marketing or paying another bill. It is challenging to balance accounts payable and accounts receivable. You want to make sure that your customers pay you as quickly as possible. And you want to make sure that you pay your vendors as slowly as possible, or as how they permit. Ultimately, you want to have, you want to have and be generating excess cash flow from profitable operations. The shower head in this diagram represents your paycheck. The broken pipe represents how depreciation can be used to reduce your taxable income. We're not going to get into exactly depreciation at this time. That's a good question to share with an accountant, but I can let you know that many times when a bank is reviewing your financials, depreciation is a line item that we can add back to help meet your debt service coverage. So we have a question out there that asks, would vendors ask for a balance sheet? Normally vendors will not ask for a balance sheet. Many times, they might do they might send to your bank a letter of reference. I've seen many credit references or letter of references that they'll send over to the bank that asks simple questions like, has there ever been overdrafts? They might ask for an average balance and deposits, but many times vendors, we don't see vendors asking for a balance sheet. They'll ask for a bank reference or a credit reference that they'll send over to the banking institution. So, okay. Okay, on page 10 of your participant guide, we're going to look at the cash flow statement for the wired cup. So, okay, cash flow statement. Okay, it's a valuable decision-making tool for business owners, investors and creditors, for investors and creditors. It also allows everyone to make a smart, informed decision about your business. In this example, Bob made projections based on 2 months of actual experience in August and September. He does not know how much seasonality there's going to be, but he does know that they have their summer vacations at college will affect the business. He assumes the impact will be significant. The first column lists money in categories such as loan receipts, owner's capital, and so on. And money out, such as operating expenses for accounting, accounts payable, debt, advertising, and so forth. The second column represents Bob's opening balance sheet and startup costs. Okay. The rest of the columns represent monthly income and expenses as mentioned before. Bob has 2 months of actual expenses based on what he knows so far. He projected income and expenses for the rest of the year. Notice that Bob had $5,000 in available cash. His sales were $25,000 and his sales tax was $1,563. A note about the sales tax. Put this in a separate bank account. Do not commingle tax money in your regular bank account. You're collecting taxes on behalf of the government. This is not your money to use. Most likely, you'll be required to pay this quarterly or even monthly to the government. The payroll tax rate used in this example is 15%. You will need to determine the appropriate local, state, and applicable federal taxes. In August, the Wired Cup had a total inflow of $26,563. So that's made up of $25,000 of sales revenue plus $1,563 of sales tax. That means that at the end of August, Bob's total available cash was $31,563. If we take a look at the bottom of the spreadsheet for August, we see that $29,253 was cash outflow for the month. Some cash outflows are fixed month to month, such as Bob's lease payment of $1,350 and the cable internet payment of $200. Some cash outflows are variable, such as advertising and utilities. Variable amounts fluctuate from month to month. You have some control over how cash flows in and out of your business. For example, for sales, you decide what you will sell, where, to whom, how, and what the price will be. The same goes for expenses. You can decide what space to lease, how much debt to carry, when to advertise, when and how much raw materials to purchase, and how many staff to employ. In August, Bob has available cash of $31,563 and cash outflows of $29,253. So taking a look at this, you have $31,563 minus $29,253 for a total of $2,309 in his bank account at the end of August. This $2,309 becomes the beginning balance for the month of September, and the process starts all over again. So then when we look at September is $2,309 plus $27,000 plus $1,688. That gets you $30,997 available for cash in September. Monthly expenses are $29,778. So when you subtract the $29,778 from the $30,997, you're looking at cash available at the end of September, $1,218, which becomes the beginning balance of October. So to sum it up, Bob is happy. The Wired Cup is doing well, but he's worried about the rest of the year. He projects he'll be able to pay for all his financial obligations, but he will be cutting it close. Some business owners overestimate revenue and underestimate costs. This means that they will at some point have a cash flow crunch and will not have the cash available to meet their obligations. To prevent this, consider developing a couple of cash flow statements. Best case scenario, this would be an ideal situation where all your dreams come true. Worst case scenario is that this would be much more conservative scenario where you do not get the sales revenue you would hope for and costs are higher. Most likely though, this would be like the Goldilocks story, not too hot, not too cold, but just right. It is the most likely scenario somewhere between the best and the worst case. In this example, Bob created the most likely projection. Given that he knows the students in the faculty leave for vacation in July, he projects a negative $4,316. You don't want a negative cash flow situation. Negative cash flow means basically you're done, game over. What you want to achieve is excess cash flow from profitable operations. This is when you can shower yourself with some cash, and it's a lot better feeling. So what can Bob do? So if you want to turn to page 11 of your participants guide, Bob needs to turn some valves wide open and turn down others in order to hold on to his cash as long as possible. If you were Bob's advisor, what would you advise him to do? Okay, let's see. Okay, how can Bob increase sales revenue at the Wired Cup? That's the question that we would ask. How could Bob negotiate a better deal or two with his vendors and suppliers? I also want to ask, how can Bob plan for seasonal up and downs in his business? And then, Is it wise for Bob to use a credit card to offset cash flow issues? So we always, lines of credit, again, seem to be the more popular, lines of credit when it comes to banking and people asking for lines of credit. We always want to make sure that when you're using a line of credit, it's exactly for working capital. The intention is to use the line of credit and to pay down. Generally, interest rates for lines of credit can range anywhere between like prime plus a half to prime plus 3. Many banks will offer lines of credit that are under double digits, but they do want to see it revolve, meaning that, it's intended for just to bridge gaps between income. And, every now and then we do find that businesses will use a line of credit to purchase debt that's intended to be paid over a longer period, over a long term, which generally would mean over a 12-month period, so longer than a year. This is something that banks will often recommend to do a term loan so that that you get that paid off. We don't like to see long-term debt paid with a line of credit. Generally, the payment terms on lines of credit are interest only. So many businesses can actually get in trouble using a line of credit for long-term debt because they get used to paying the minimum payment of interest only, and they never reduce the principal of that line of credit. And, the financial institutions and banks will review and usually do an annual review on lines of credit to see how the line has been revolving. So we do, at that point, we'll either renew the line or we'll offer to term out a specific amount that has not been paid down. But lines of credit are intended to use and to pay down, to just basically bridge the gap, the money that you may need when it comes to seasonality. So,
Hey, Eduardo.
Yes.
Hi, Eduardo. This is Edgar Jimenez, a business advisor here at SBDC. Thank you so much for your great presentation. But I do have a question.
Sure. Go ahead.
Based on that spreadsheet, it looks like, let me ask a broader question.
Sure.
Do you find, though, when you look at cash flow statements, that sometimes the hard conversation comes from the bank, that your recommendation is to close it down? And the reason I bring that up, the way the spreadsheet looks like, he's not paying himself. So it looks like he's profitable, but he's not getting paid. So you could almost argue that his salary is a hidden loss. Number two, there's also some things that looks like he's spending for ingredients during the summers when employees are not there. And also, does he need all 3 employees when it's slow? So anyway, I just wanted to come back to, obviously, from your experience. Yeah, it's an objective perspective, but, and I feel it's also a reality check for a lot of our clients, is that sometimes there's a go, no-go decision. And when is that a good conversation to have with their banker? And what have you seen, and what's your philosophy on being frank with your important clients?
Great question. And we see it often with small business owners and maybe startup businesses where, they may have they may work in a specific industry or have a business where they do receive payment via credit, but they might get a lot of payment in cash, and they're not always, reporting the cash. But we do want to make sure that our business owner is reflecting enough income to be able to support their personal debt. We often see really good business tax returns, but when we're looking at the business tax returns, we realize that the salary, the income that they're paying themselves, it doesn't make sense. That it doesn't look like they're paying themselves enough to be able to support their mortgage payment or their car payment or their personal debt. So it's really important that while you may have positive net income on your business tax return, it's also important to realize that it's not just the business tax return. We'll look at the personal tax return, and we just want to make sure that, does this make sense? Could this individual live off of what they are reflecting as far as their income? And that's something that comes up a lot, and often we have to, the business may qualify to carry the debt, but then what we do is we do a global debt service coverage, which means that, yes, the business can afford this loan, but is the borrower paying himself? Does he have other revenue streams that look like they can support his monthly debt that's reflected on a tax return? So yeah, that's a great question, something we always want to make sure that, everyone always wants to minimize their tax liability and tries to pay themselves as little as possible to not have to pay taxes. But just remember, if you're looking to borrow and you're looking to grow the business, you do want to make sure that you are paying yourself enough to be able to, maybe purchase that home or buy that additional vehicle or support the personal credit cards that you have. So that's again, a great question. And, sometimes it doesn't always come up. We will have someone at the end of the year that just realized that, I'm not showing enough income for myself, and then they're scrambling, and then they realize that they're going to have to pay a lot more taxes at the end of the year. So,
and also, Eduardo, I would offer also to our attendees today that the thing about a cash business, sometimes they're trying to pay off debt with cash, like with certified checks instead of proper, account checks, business checks, and
Yes.
that becomes suspicious, especially with vendors, because then it looks like you are hiding your real debts. Like, why does someone paying cash instead of drawing against their checking account? It could indicate the checking account doesn't have enough money, so they're getting cash elsewhere, and it makes it not only not a good situation for other vendors, but then it becomes very suspicious when they file their taxes, let alone obviously when they're servicing debt. And then they're missing a payment, or maybe they're calling to say, hey, Eduardo, I'm going to be about 2 weeks late. Can you do X, Y, Z? It raises all kinds of red flags. And I think at that time, that's probably when they need advice from their lawyer, their accountant, their banker, or even a business advisor or a consultant to just take a hard look at their business and separate emotion from reality. And the reality is, do you have the cash or not? Got to make some hard decisions and keep that business going, or decide otherwise. But thanks, Eduardo.
Exactly, Edgar. And a paper trail is always important. Like for example, there may be financing needs that you need where the bank might not be able to finance 100%. Let's say for an equipment purchase that a bank will finance 80% of the invoice or purchase price, and they will require 20% down. They're going to want to source where that down payment is coming from. So keeping money in your checking account and showing where the funds for a down payment are coming from is going to be very important, because they don't want to know that you're possibly borrowing those funds or taking out a loan or you getting a personal loan. The bank will always want to know what the terms are of that money that you are borrowing for a down payment. So they really would like to see that money is in an account. And like you mentioned, when you're paying your bills, if you have anyone that's paying you, let's say you own an investment property, you own multiple real estate ventures, and you have some really good clients that pay you in cash and some that pay you in check. I can't tell you that it's very difficult to prove, especially if you have, like, if you're mid-year and you raise the rents and you don't have proof that someone is paying you a higher amount of rent, that's an issue. So we always ask, if you're collecting any kind of rent payments, to make sure that you get paid via, a direct deposit or a check. So it's good to have a paper trail for what you're doing. So, and again, thank you, Edgar, for those good points. So let's see here. So let's look at some possible ideas for Bob. Okay. So what we want is okay. So we have Bob can increase the flow of revenue into his business. What we're going to want to look at is Bob can reduce outflow, perhaps by making arrangements with vendors or his landlord. If Bob pays his whole entire rent in 10 months, he will pay more during the 10 busy months and no rent in July and August, which promises to be slow. So just think of creative ways where you can actually, knowing ahead of time that you're going to have certain months where income may not be, that great. See what you can do ahead of time to kind of prepare for that. Like, a great example is landscapers. I have many landscapers that are very seasonable. It's, a lot of what they do is geared towards the summer months. Not all of them do, snow plowing. And lately, a lot of landscapers that have been doing snow plowing it's just been hit or miss with the amount of snow that we get. So landscapers are really big on specifically planning for the future. We can have here in this scenario, we can have Bob might cut back when he expects business to slow down. So perhaps his staff can work fewer hours, or he can cut back on some of the menu items. The point is that by managing cash flow, Bob is able to control his business over the long term. He can be strategic and plan ahead. So, okay, what not to do is, here's some examples. So never use your sales tax as a financing option. Some business owners use sales tax in a cash crunch, hoping that they replace the tax when things are looking up. This is a risky bet. Penalties are high for not paying your taxes on time. We see this a lot. Our bank, if you're doing a commercial real estate loan, a lot of times we want to go ahead and we want to establish the tax escrow for you. So it's basically with your monthly payment, we'll also collect your monthly tax liability for your real estate tax, because that way we know it's going to be paid on time. What we see is sometimes when we do have borrowers that want to pay their own taxes, when things get slow, they'll dip into the money that's meant for taxes, and then they're stuck in a crunch when it's time to pay your taxes. So if you anticipate that you might miss or be late on any loan payments, talk to your loan officer as soon as you know. Loan officers understand cash flow and typically all the business challenges that you may have. It's in our interest to make sure that you don't fail. We want to make sure that you have any support and every support that we can possibly give you to make sure that you make your payments on time. To do not pay vendors late, they can cut you off. So for a lot of you that are looking to establish vendors, many times, I have some businesses where they may have, for whatever reason, paid vendor late. Then the vendor does not allow them to pay them with checks anymore. They'll ask them for certified checks, cashier's checks. They may cut them off completely, or may raise their rates on the prices of goods. So that's, you always want to make sure that you can pay your vendors on time, or just talk to them, because paying vendors late can get you in trouble very quickly.
Eduardo, I'm sorry, Eduardo, if I could also offer for all of you business owners or those who are doing startups, you also, I think that third bullet is incredibly important to also consider for your own business. Like, for example, if let's say you supply coffee to coffee shops, let's say you have 100 accounts, they're likely going to pay you over them paying, let's say, for the printer of their flyers. So then those of you who are in the print shop business or flyers business, just understand, and therefore you have to think about how critical is what you do to those coffee shops. So again, it's just a double way to look at it as well, because really in the end, as a printer, you're going to pay for ink and paper, but would you pay for that person who's handling your social media? Just like if you're supplying the coffee grounds, you're going to get paid for your coffee. But on the flip side, you have to think about from your own industry or what you offer, what kind of risk you have, or how critical are you to those businesses when you do your risk analysis and when you project your cash flows, especially when the economy ebbs and flows or as things happen locally. But I thought that third bullet's incredibly important, but thank you for pointing that out, Eduardo.
Yes. And again, I have many restaurants that, that bank with me, and I get to see the vendor, the vendor bills and yeah, it's definitely, I want to make sure that even, if I know that it may be tight for them, and, every now and then a customer gets overdrawn, but I do know, they have conversations with me. I make sure their items get paid because I know that they're going to pay, they're going to make their account good. So it's good to have those vendor relationships. Don't overestimate your revenue. There's a common mistake made by many new businesses that owners tend to make, that yes, you want to have confidence in your business, but don't overestimate your revenue, because that can get you in trouble. And then don't underestimate your costs. Again, this is a common mistake in many startup businesses. Do your homework to find out what the real cost of doing business is. So, and then here we go. Is it professional to ask for help? Okay. I know many people that they want to prove that, that they've done their homework, and they often, are not comfortable asking for help, but it's not a sign of weakness. If financial management is new to you, Don't be afraid to ask for help. Find a great accountant or a technical advisor at, SBDC or SCORE, or, reach out to any of the organizations that offer financial assistance. We can help you with, explain cash flow and just the concepts of owning your business. A good accountant will encourage you to use a computer to manage your cash flow. QuickBooks is a very popular program that they have different versions and many different levels of QuickBooks that may work for you, and it can help you get organized. If you don't already use financial management software, take a course to develop the skill. You'll also need to manage your paperwork in a professional manner. Set up a reliable filing system to keep track of all your financial documents, such as tax forms, receipts, invoices, and so on. Check out the toolkits of resources in your participant guide, because there is a toolkit there for ideas on where to locate technical assistance. Okay. Key points to remember. So managing cash flow is a core competency of small business ownership. A balance sheet will tell a compelling story. A cash flow statement continues that story. Use it to monitor your projected and actual income and expenses. Plan for seasonal fluctuations. Every business has ups and downs. Ask some of your competitors when their usual slow times tend to occur. Try to maintain a rapid cash conversion cycle. Try not to tie up too much of your cash in inventory. Lease equipment instead of buying it if it's a better option. If you do buy equipment, buy used if you can. So, there are a lot of businesses that have a lot of inventory. So you would think, we kind of look at that in different ways. Inventory is an asset, but if that inventory is taking you a long time to sell, it can become a liability. So, we've come across several different types of businesses that just every year their inventory tends to go up and up and up. And, a lot of times we ask the question, how often do you cycle your inventory? How long does it take you to sell that inventory? Because sometimes that may paint a picture of what's selling and what's not selling. So, just look at your inventory and look at the cycle of how often you're able to sell what you have in inventory. Manage your paperwork like a pro. Your accountant will expect to see spreadsheets, an accounting program, well-organized receipts, invoices, financial statements such as your banking statement and credit card statements. So just make sure you keep track of all of that. Your accountant will need all your bank statements. They will want to see a paper trail of money coming in and out. So ask an accountant for advice. You can, shop around. There are a lot of accountants out there. And, I always say, be careful. Sometimes there are tax preparers and there are accountants. There's an obvious big difference there, but just kind of shop around to see who you feel comfortable with, and, check out if there's any, information on them over the internet, because that can give you a good indication of, whether or not there's compliments or complaints about a particular accountant or tax service. So
yeah, if I may, I just want to say that spend for the accountant. They're not just a bookkeeper. They have many ways of leveraging your inventory management, making sure your paperwork's being followed correctly, recommending QuickBooks or really good software so it makes it easier for you to track expenses. Because an accountant could be a couple $100 or a couple $1,000 a year. We can save you tens to hundreds of thousands of dollars in expenses, let alone problems with the IRS. So look for the accountant, talk to at least 3. They'll want to talk with you. So just to talk to them doesn't cost any money, but get a proper accountant, especially when you're first starting out. It'll save you all kinds of headache. And honestly, it'll keep your bankers happy, because then the banks will know that a proper CPA is handling your documents. It helps in so many ways.
Yes. So looking at just additional resources. So just make sure that that your participant guide does have a toolkit for resources. There's a glossary there of common cash flow terms. So if there's, words that we may have talked about that you don't necessarily understand, or something that you have seen before and have always wondered what it was specifically, take a look at that toolkit. We have a sample cash flow template that you can use. We have tips for negotiating better terms with customers, vendors, and suppliers. And there's plenty of resources within within the participants guide. So what I'd like to open up, we don't have a lot of time, but if there's any specific questions that someone may have regarding just banking in general, I can answer some quick banking questions, some startup questions, some resource questions, just any tax questions. So we'll kind of open it up for the couple minutes that we have left. So let's see.
Eduardo, one thing that we emphasize here at SBDC is we always ask our clients to work on their business plan, because not only is it good for planning, it's also good for investors and banks. Just if you could illuminate a little bit on that, where the business plan comes in when they come to talk to you for an SBA loan or a line of credit.
Yes. So there is you may have heard the word business plan a lot, and a lot of people think that a business plan is an idea. It's more than an idea. It's you actually putting your idea down on paper. There are different organizations such as SCORE and several SBDCs that can help you come up with a business plan. But what we want to see in a business plan is we want to see, does the business plan look realistic? Does it plan for contingencies? Is it, a lot of people's business plan has, great ideas, and it's very, very positive, but we really do want to look at the numbers. We want to look at your expense, your forecasted expenses. What do you have listed for contingencies? How are you going to market yourself and the business? So, we'll look at what type of marketing plan you have on there. We'll look at projections. We have worksheets and spread, and we have different worksheets that we can provide you that will give you an idea of what we look for projections. So, projections can be important. Knowing that a projection is going to be modified based off actuals, we'd like to see how you project your growth when it comes to income, also your expenses. Are you projecting adequate expenses, and how things are changing? So, having a business plan is again, it's your idea, but how are you implementing your idea? What steps are you taking to make sure that you cover what you need to cover? And a business plan is great to review with your banker, because many times you don't want to go to the bank right immediately when you need the money. You want to prepare yourself in order that when you go to talk to your banker and ready to apply for the loan, you know what you need, what the bank is going to ask for. That way, your possibilities of getting approved will be a lot higher, knowing what the bank is looking for, specifically when it comes to your debt service coverage. So debt service coverage is what we look at as your income divided by your expenses. For many banks, that ratio is 1.2. So what that means is basically for every dollar of expense that you have $1.20 in income. So debt service coverage is a number that you'll hear from your banker often, and different banks have different debt service coverage requirements. So, we can talk to you about that. And again, business plan is really important for that. So yes.
That's great, Eduardo. Yeah, it's have regular meetings with your banker and have that business plan. And really the great thing about business plan, it forces you to understand not only your challenges, but enable the banker to understand that you have a really good idea or a plan to be able to get that loan or service the business. Just to close things out, Eduardo, I do have a question from Houston Liu, and I'll just read it straight up. Thank you for your presentation. His question is, if I invest some personal money for cash flow temporarily, how can I take it out? And is it a good method to get a short-term loan, such as a 1 month for cash flow? A 1 month loan, it sounds like Houston's asking about.
Sure. So we recommend more than just like a line of credit, because a line of credit will bridge the gap in, especially when you know that, for example, if you have a slow pay or a late pay, but it's somebody that, it's a good client, maybe you've had them for a long time, but maybe that they're experiencing experiencing some hardships and may pay you, and instead of paying you in 15 or 30 days, they're going to pay you in 60 days. We always recommend, a line of credit to kind of bridge that, but just make sure that you're going to be having that income coming in. And the first part of your question was the owner's equity. So we do see a lot of, there is credit to be given to a business when we see that the owner of the business has injected their own, personal savings or personal cash. And, that's something that we look at and we account for when we're doing our analysis, is how much of the personal cash or savings has been put into the business. So, you can always take out that equity, but just know that, that equity is used to kind of measure the overall assets of the business. So, and it's something that we see all the time. We see huge, owner's equity, and sometimes we don't see any owner's equity. So, we don't see it as a negative thing that if you have to go ahead and pull out, some of the equity that you've put into the business. We'll just kind of get an understanding of what your future, income and expenses are going to be. So that's a good question.
Thanks, Eduardo. Well, I want to thank everyone here for attending. Eduardo, just want to thank you again. This has been tremendous. And for everyone's reference, there's the link for the invitation for next month. So on September 28th, we'll be meeting with Eduardo again. So sign up for the Eventbrite. Please spread the word. Let all of those out there who are in the business side and share that this is a free, available, no cost webinar to get some expertise from Eduardo and from Old National. We thank you again, Eduardo, and thank everyone for being here. And this will be it's being recorded, and this will be available for sharing probably in a couple of days. But thank you, everyone, and have a wonderful weekend. Thanks again, Eduardo.
Thank you.
Yeah.